In this video, I wanted to talk about how my income portfolio has been changing throughout the years. Ever since I started my investing journey, I've been making changes in terms of what I invest in and how much I allocate to certain investments. And the high-yield investment landscape has been evolving throughout the years in terms of what's now available. For example, when I first started high-yield investing, there were less than 10 covered call ETFs that existed. And now, according to ETF.com, there are now over 450 that exist, and I'm sure that number is increasing almost every week. Some investment types have become less appealing, in my opinion, for those seeking higher yields. So I wanted to highlight 3 ways that my own portfolio has been evolving over the years. Many of these changes I've been making gradually over time, and I haven't made any official announcements about the shifts I've made. They've just been very slowly happening, so I'll discuss what those changes are and why that is. The first way that my portfolio has changed over time is that I now avoid almost all REITs. When I first started investing in higher yielding stocks and ETFs, REITs were a category that I found very appealing because many of them invest in government-backed mortgages. Annaly Capital was one of my very first high-yielding investments around 8 or 9 years ago because they touted having a very large portfolio of agency MBSs. These investments are fully backed by government-sponsored enterprises like Fannie Mae or Freddie Mac. And if you look back at some of the older REITs like Annaly or AG&C, they actually performed really well 10 to 20 years ago. However, especially over the last decade, almost all REITs have been pretty mediocre. Many of these companies regularly go through dividend cuts and have seen declining share prices. And it's not just something that started recently with higher interest rates. Even as rates were going down, these investments were still performing pretty poorly. I haven't done enough research as to how REITs have changed since the early 90s, but clearly something has been going on with this asset class. Annaly actually grew their dividend many times throughout the 90s and even the late 2000s. But it's been going downhill for Annaly and nearly all other companies in this sector. Now, mortgage REITs can still be very good investments, but they're very cyclical, unlike a lot of equity REITs. And what I mean by that is, equity REITs can still grow their dividends throughout various market cycles. Some REITs, like Triple N REIT, have grown their dividend for decades without needing to cut it. They've survived the financial crisis, COVID, and various market conditions. REIT dividends depend significantly on where we are in the market cycle. Over the years, I've sold out of many of my REITs and have used the proceeds to buy holdings in other asset classes. I did say that I avoid nearly all REITs because I do still hold a couple of them. Unless there's a dramatic shift in this sector or a brand new company appears with their own unique strategy, the following are the only REITs that I'll either ever own or consider owning. Rhythm Capital, ticker RITM, is extremely well diversified as they own various other real estate companies in their portfolio. They also focus a lot more on mortgage servicing rights and not as much on mortgages like most other REITs. Starwood Property Trust, ticker STWD, has an amazing track record of performance and is very well diversified, unlike most in this category. They're actually building up a portfolio of physical properties, so they're more like a hybrid REIT than just a pure REIT. And then there's Arbor Realty, ticker ABR, which is another company with a great management team. They have fallen on hard times this year, like most in this sector, but their ability to grow their dividend is incredible. Multiple times this year, they've already stated that they intend to restart this dividend growth in 2026. I suppose I could hold preferred shares of an REIT at some point, but these 3 companies going forward are likely the only companies I'll consider in this sector. A second way my portfolio has evolved is, when it comes to business development companies, I'll likely focus much more on internally managed BDCs, with a couple of exceptions. In previous videos, I've talked about the difference that exists between internally managed and externally managed BDCs. Although externally managed BDCs aren't necessarily bad, and in fact my favorite BDC is externally managed, internally managed BDCs align management's best interests with that of shareholders. With external BDCs, usually the management team is compensated based upon assets under management. The board members are paid a percentage of all the business they've been able to attract and manage. But with internally managed companies, the executives are compensated on company performance, not how big they are. So you can imagine that internally managed BDCs are more attractive for this reason. And if you compare the performance of internally managed and externally managed BDCs, the internally managed ones usually perform much better over the long term. But again, that just makes sense because that's how management is compensated. Some examples of internally managed BDCs would include Main Street Capital, Hercules Capital, Capital Southwest, and although I don't currently hold them, Trinity Capital is another internally managed company. Now, there are a handful of externally managed BDCs that have done very well or they have very favorable structures that make them worth considering. Ares Capital is externally managed, and they've been one of the best performing companies in this sector, even beating the S&P 500 in terms of performance over the long term. Blue Owl Capital is another externally managed company that has a very high quality portfolio. Blackstone Secured Lending Fund is also very high quality and has a very high amount of spillover. With this high amount of spillover, their dividend is very well covered should things get more difficult for them. But nearly all the BDCs I've been selling out of over the years are externally managed, which include companies like Triple Point Venture Growth. Oaktree Specialty Lending was another BDC that I used to own, but I sold out of it not too long ago. Even older than that, I used to hold Barings BDC, but sold out of that I think a few years ago. I'm not saying external companies can't present good buying opportunities at times. If I see a good BDC with a great strategy that is external but is trading at a good discount, then I would consider buying into it. But internally managed companies on average do better over the long term, and that's why I now stick to prioritizing them and investing more into those than external companies. Another way my portfolio has changed over time is I've become much more diversified into a lot of different high-yielding investment types. Around the time I started my YouTube channel, REITs and BDCs made up well over half of my portfolio, which was a risky thing to do. Many people that I talk to who love high-yielding investments often flock to BDCs, covered call funds, and maybe some closed-end funds, and that's about it. But there's plenty of other options that exist that might not offer the same yields as great as what I just mentioned, but they can offer more stability and dividend increases. As time has gone on, I've been expanding into new categories and asset classes that offer comparable yields, which is really good for diversification. There's plenty of higher yielding options that exist that don't necessarily get a lot of mainstream media attention. This can make it harder to find, so it does require some research. But for example, there's a number of higher yielding international stocks or international dividend funds that can offer good global diversification. Master limited partnerships do get a little bit of coverage, but I do think they deserve more since they can offer amazing dividend growth and yields of 7 to 8%. I don't currently hold any, but CLO funds are another asset class that come with higher yields that you rarely hear about. Then there's also preferred stocks and preferred stock ETFs and closed-end funds, and then you have convertible bond funds, and just a lot of other options that exist. So over the years, I've been diversifying more into these additional categories. So those are a few ways that my portfolio has changed over time. Sometimes it was a matter of improving efficiency, while other times they were difficult lessons. If you disagree with any of my points, like if you think mortgage REITs are good long-term holds, then let me know your thoughts. Or if you have any suggestions, feel free to share them in the comments. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.